Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
Welcome back to Learn for Finance, your podcast about smart investing. Today, we're again discussing the best seasonal stock opportunities in August. Are you new here? Don't worry. We'll explain everything.
Maybe you've already heard. Many trends repeat themselves at the stock exchange, always at the same time. This is called seasonality. At Learn for Finance, we use this principle for our portfolio and show you how it works.
If you want to learn even more, you'll find our comprehensive seasonal explanation video directly embedded here or below in the description. There you will learn why timing in the stock market is not a game of chance, but can have a system. Remember that. And how our favorites perform in the portfolio, you'll see right after our presentation of the seasonal August stocks. So stay tuned.
Exactly. In our depot update, you'll also see how our June stocks performed. And now, enjoy the current stock stars. And as always, if you have any questions, just write them to us in the comments.
Good, Lisa. Then let's put our foot down. In today's August issue of our seasonal stock trends, I have an extremely exciting trio for you. Even a summer lull can be interesting.
Super, Axel. I'm really curious. You should be well rested after the long video break. Oh yes, you're talking about a new stock trio. Do you always present 3 stocks? When we started in June, it was the same.
You always have to be well rested with you, just like you grill me. Today could again be fun. To your question, no, the current trio of stocks as a total number is purely coincidental. Our stock calendar, ranging from 90 to 100 stocks, is seasonally distributed throughout the year. The number of stocks presented mainly depends on the space in our portfolio or the available stocks within the respective month.
Sure, makes sense. I completely forgot about our seasonal stock portfolio, which we always present after our seasonal individual stocks.
I'm glad that I at least had enough sleep now.
You cheeky rascal. Grilling is the right keyword, Axel. August is considered difficult. I'm here to find out whether your 3 candidates are really heat wave champions or just hot air. Isn't it just a boring bank?
Challenge anything accepted. But boring. Your greatest strength is the consistently digital business model, an innovative strong customer loyalty, transforming French and a rock-solid capital base, and an American cloud powerhouse. That is the defensive side. They couldn't be more different.
Okay, digital
but the
and
seasonal
secure,
data and
understood.
fundamental facts.
But does that also bring growth?
Let's start
or is it just about
Netherlands
managing?
With our solid growth is coming from ING Groep. Revenue, a European financial giant with over 37 million customers, and profit that has reinvented even itself. By almost 9%. That's more than the population of Canada. And all this with a ridiculously cheap price-to-earnings ratio of just 8. This is extremely undervalued for a digital powerhouse.
This is a strong package, but where's the catch? Every company has weaknesses.
Absolutely. The biggest weakness is the clear dependence on the interest rate environment. Rising interest rates are good, falling interest rates squeeze the margin, and the main risk is a deep recession, which could lead to loan defaults.
Fundament check completed. But now, on to the timing. Convince me with the seasonal data.
Period, purchase, 21 August to sale, 10 November. Hit rate of almost 87%. Average performance, plus 12.2%. And all with a maximum drawdown of only 5%. That's almost Zen Buddhism for a stock. From solid bankers, we now move to the adaptable energy giant, TotalEnergies from France.
Total. That's a classic oil multinational, isn't it? Does it even still fit into today's world?
That is the exciting point. They are undergoing change and are heavily focusing on a strong ESG emphasis. Their strength lies in the enormous cash flows from their legacy business, which they use to finance their opportunity as future leaders in green hydrogen and solar energy.
A bet on the future financed by the present. Does it work? What do the growth figures say?
It works impressively. The profit growth has averaged a strong 15% over the past 3 years. and the stock is extremely cheap. A PE ratio of less than 7, a PEG ratio of 0.43, and a dividend yield of almost 6%. This is a pure cash machine.
Okay, the fundamental data is solid, but the risk with oil stocks is always the commodity prices and geopolitics, isn't it?
Correct. That is the biggest weakness and the main risk. That is why timing is so crucial here. And seasonally, the stock is an absolute fortress. Period. Purchase 20 August to sale 10 November. Hit rate almost 86%. But now listen up. Volatility below 5% and a maximum drawdown of only 3%.
Minus 3%, that's incredibly stable. A defensive anchor with top dividend and extremely reliable timing signal. Okay, we had the solid bank and the stable fortress. Now you need something with real punch, right? Is the tech hit coming now?
You know me. Here comes the cloud powerhouse from San Francisco, Salesforce, the undisputed market leader for CRM systems, purchased from August 19th to August 31st, the sales day.
Salesforce in August for only 9 trading days? Is that an April Fool's joke from you? Tech stocks are often expensive and the competition is fierce. Is that why the short seasonality? Because they are so risky?
No, not an April Fool's joke. We're in August. Yes, that's by far the shortest seasonality. 9 trading days sounds a bit crazy. You touch on the right points. The evaluation is the biggest weakness. But their strength is the absolute market leadership. And they are growing rapidly. Revenue with almost 19%, profit with over 25% on average over the past years. That justifies the price.
And the future? Where should even more growth come from?
The greatest opportunity lies in integrating AI into its vast platform ecosystem. This will bind customers even more closely. The clear risk is economic dependency. When large companies need to cut costs, Salesforce feels it immediately.
Understood. Growth has its price and its risk. What does the seasonal sprint pattern look like?
Yes, let's get back to your April Fool's joke. An extremely strong short pattern just for the month of August. Hit rate, almost 86%. Average performance, probably 6.33%. But here we see the tech character. The maximum drawdown was a noticeable minus 16%. My comment here, we will still include this stock in the portfolio. With an average return of plus 6.33% and such a short seasonality, that's acceptable. But the very high drawdown of minus 16% justifies an investment only within a portfolio, as we do.
Okay, so this is the candidate for the opportunity-oriented. Fundamental growth is top, but with seasonal risk. What is your conclusion?
Exactly. We have 3 August champions with very different characters. ING, the digital and fundamentally inexpensive banker. TotalEnergies, the defensive value giant with a green story and top dividend. And Salesforce, the growth-oriented tech sprint with very short seasonality but also high volatility risk.
A perfect mix. Now it's your turn. Which of these 3 August types best fits your strategy? The banker, the tanker, or the techie? Write it in the comments. We are very eager to hear your opinion.
And always remember, seasonality is a powerful tool, but not a crystal ball. Combining it with fundamental data makes the difference.
Perfect, Axel. Then let's start with our depot update now. I'm sure our viewers who followed the first starter podcast video from June with us are already excited. How the June trio has performed so far. Hello everyone, and now it's time for our seasonal portfolio update from Learn for Finance. Today is August 14th, 2025, time for our highly anticipated portfolio update. Axel, I can already see you with spreadsheets, charts, and that slightly mysterious expression. What's coming today? A celebration or a risk break?
Hi Lisa. Very nice. You're back in top form. Today we're talking more about a solid ride with built-in seatbelts. Our model portfolio is up by 25.8% since inception, even though the MSCI World is currently at plus 34%.
Aha! 8% behind. That almost sounds intentional. Axel, explain yourself.
My little Sherlock Holmes. Intention? Let's call it seasonal strategy. Actually, you know that due to the seasonality of individual stocks, a cash reserve is automatically built up temporarily. This results in less roller coaster and more ice train rides.
Thank you very much for the explanation, Watson. Okay, train journey sounds good, but also boring. But what does that mean in numbers? Is that just an excuse for less return?
All right, let's get you out of boredom. So, when we talk about numbers, we need to keep in mind 2 points that we already mentioned in our June video. 1. The seasonal equity portfolio serves as a depot mix. 2. Since it is an active approach, the fluctuation of this depot should be lower than our baseline investment MSCI ETF World. That brings us to the figures. Look at this chart. On the vertical axis, the return. On the horizontal, the risk, i.e., the volatility. Our portfolio, 25.8% return with only 12.5% fluctuation. The MSCI World, 34% return, but with almost 18% fluctuation. In other words, it's not just about absolute returns, but about risk-adjusted performance.
Okay, little darling, now, for me as an average consumer, it means the MSCI World ETF was the free-fall tower, you the more leisurely roller coaster. You also reach the destination, but with less thrill.
Exactly. The seasonal concept ensures that we often build up cash during critical market phases. This automatically reduces volatility. We are currently operating with a total value of around 123,000 euros. Of this, over 20,000 euros is a cash buffer, profits that we consciously choose not to reinvest at this late stage of the market. So, my additional intervention, due to the overheated stock market. Additionally, there is cash from the lack of buy signals.
Yes, that's right. We already discussed that in the June podcast. So you're just letting 20,000 euros sit idle as an emergency chocolate reserve instead of making it work for us?
Let's call it strategic additional safety leave. In Q2 2024, we temporarily had over 80% cash when the market was rising. But that was due to seasonality. Yes, it costs short-term returns. But when things go wrong, it also saves our nerves. Why? We're simply blocking our previously realized profit. The seasonal strategy now continues only with the original 100,000 euros. The price? We're moving upwards with limited momentum.
Makes sense.
And if you like, we also live by the principles of our learning channel, Learn for Finance ourselves. Just now, with seasonality. We are taking a close look at the approach. What are the strengths and weaknesses? Only then do we invest. And that's exactly what's great about YouTube. Everyone can choose the finance YouTubers that suit them according to their preferences. Some might think, nice enough, but my grandma with her rollator is faster than the team at Learn for Finance. Fair. But I follow a clear plan and structure when building wealth, and that's exactly what we teach at Learn for Finance.
You're quite spry for an grandpa. Okay, understood the strategy. Let's dive deeper into the portfolio figures today. We always take a closer look at one section per video.
Certainly. The Sharpe ratio is at 119. That is a top value for the return achieved per unit of risk. The maximum drawdown, i.e., the maximum loss since January 2024, was only minus 11%. Very solid.
Sounds almost too good, but a trading fan like you surely drives the fees up, right?
The portfolio metrics described above are in a very good range for the many seasonal signals. But you are right. The many trades can become a problem. The turnover rate, meaning the buying and selling of stocks, is almost 400%. This has cost us around $2,953 in fees so far, or a 2.93% return. That is the price for high activity and flexibility. And that is exactly why it should be tested beforehand.
Clear statement, Axel. Then let's get to the individual stocks in the depot. And especially, how did the 3 newcomers from our June video perform? So ResMed, Alphabet, and Apple.
Since the last update, Block, an old stock, with a plus of 28%, and PayPoint with a 27% increase, were sold at a profit. ResMed also exited the portfolio with a profit of 8%. The biggest realized losers were Exponent with minus 13% and Zoetis with minus 16%. Our June editions, Alphabet and Apple, are currently performing very well with plus 15% and plus 16% respectively.
A few slips, but no drama.
Exactly. Currently, we are 55% invested, the rest is cash. In the portfolio, among others, are Games Workshop, Amazon, PayPal, and Ferrari. You can see the complete list here. What comes next? September, October are historically exciting. In 70% of the last 20 years, October saw an upward trend. We expect many new signals, and our cash could then be worth gold.
That means for you, prepare coffee, ring the bell. Autumn will be exciting, and now it's your turn. Prefer taking a full risk like with the MSCI World ETF or the safe ride with Rollett or Axel? Write it in the comments.
Very nice. And luckily, I also have poor hearing. Don't forget, seasonality is not an oracle, but combined with intelligence, it's an extremely powerful tool. Thanks for watching and see you in the next update.
Also from me, thank you very much for your interest. Until the next update, you're Lisa. Ciao.
Disclaimer: the content on the YouTube channel, Learn for Finance, is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations or forecasts are no guarantee of future results. Important note: investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.